You get a $1,000. Bet it on Micron Technology. Our extreme analysis projects a potential gain of over $15,412. That is a 259 times return. Is this insane growth possible? We dive into the numbers now. One day, one stock. Today, we'll look into Micron Technology. Welcome to StockSnack. All kind of financial numbers could be overwhelming. At StockSnack, we help to analyze stock, if they are good or bad. At StockSnack, we help justify it and present it to you. Fast enjoy, like having snack. So, here's the plan. We break this down. For easy parts, first, the who, the what. Who is the company? What are they actually selling? Who is the main competitor? You need the foundation. Then we move to part 2. This is the business side, segment analysis. We find the main money makers. What product is the real engine? What is the biggest source of revenue? Part 3 is the finances, the health check. We run a full checklist. Is the company actually healthy? Finally, part 4, the big one. The price projection. Is the current stock price a steal? Or is it just overpriced hype? We figure out the bargain or the bust. Let's start. We're starting with the basics. The quick details. The company is Micron Technology. They are a semiconductor company. What do? They design and manufacture. Their main focus is memory. Think DRAM, which is fast, volatile working memory, and NAND, which is slower, non-volatile storage. This is the stuff in your phone and in data centers. Where did this all start? In the United States, Boise, Idaho, to be exact. That was back in 1978. A few years later, 1981, they started manufacturing their very first 64K DRAM chip. That was their first product. In 1984, the company went public via IPO that secured the capital needed. Moving ahead to 1998, they acquired Texas Instruments' memory business that massively expanded their global footprint. Then, in 2013, they acquired Elpida Memory. This instantly made them the world's second largest DRAM supplier. So, for business type, they are mostly B2B. Business to business, they sell those core components. The actual chips, who actualize them. Giant manufacturers like Apple, Dell, and NVIDIA. These companies build the final product. Micron is the essential supplier. Their revenue stream is simple. It's all chips. First, DRAM products. This is their powerhouse. It brings in about 70 to 80% of all revenue. That's critical. Second, their compute and networking unit. This covers things like cloud servers and high-speed enterprise needs. Think AI data centers. And third is NAND products, the storage flash memory, like in an SSD. This next part, we look at the competition. Micron is in a tough neighborhood. The biggest player is Samsung Electronics. They are the giant. They sell memory, like Micron, DRAM, and NAND. But they also sell logic chips. They make everything. Their revenue is staggering, over $66 billion. Next up is Intel. You know Intel. They make the brains, the microprocessors, CPU. Their revenue is up over $49 billion. Then there's the big new star, NVIDIA. They dominate. They sell GPUs and AI accelerators. Everyone building AI needs them. And their revenue is near $46 billion. But now, the direct rivals, the memory specialists, the closest to Micron. Number 1 rival is SK Hynix. They are another memory giant. They focus heavily on DRAM, especially HBM. HBM is that expensive high-performance AI memory. SK Hynix is in a massive fight with Micron over that. Their revenue is around $42 billion. Then you have the storage rivals. Western Digital, they are big in NAND flash and SSDs. That's Micron's storage segment. Kioxia, they were originally Toshiba Memory. They essentially invented NAND flash. They are pure storage competitors. So, Micron is fighting the massive conglomerates, Samsung, Intel, and fighting the specialized memory players, SK Hynix, Western Digital, and Kioxia. It's a small ring, but the stakes are enormous. This next section is about Micron's intangible value, the brand, the management, the future. It's qualitative analysis. The people running the show, employee feedback is strong. The executive team gets a solid B score. That puts them in the top 25% of comparable companies. Workers, like the CEO, they feel the leadership is supportive. This is a good sign for stability. Now, their competitive edge. They have two massive advantages. First, they are innovating fast. They have technological leadership in HBM, that's high bandwidth memory. It is the essential chip for all new AI systems. They are right at the forefront of the AI wave. Second, they are the only major US-based memory manufacturer that grants them strategic importance. The CHIPS Act, it's a huge geopolitical advantage. So, where is the entire industry headed? The core trend is simple. It is all about AI-driven demand. This demand is making memory pricing very strong. It's pulling the entire industry upward. And what's Micron's future direction? It's all in that HBM technology. They want to accelerate sales of high-value products. Their ultimate goal is to lead the entire AI data center market. That is their new frontier. High margins, high performance. Now for part 2, we look at the business segments. Where does the money actually come from? Let's track the growth from 2017 to 2024. First, compute and networking. This is the largest segment. It sells to cloud servers and big data centers. Revenue went from $8.6 billion to $9.5 billion. That growth is slow, just a 1.6% compounded annual rate. It's actually below our baseline for inflation, and its share of total revenue is shrinking. So, where's the action? Look at mobile, smartphones and tablets. Revenue here grew nicely, from $4.4 billion to $6.3 billion, a solid 6.2% annual growth. That's strong, predictable business. Then there is storage. This is the SSD market. Solid-state drives. This segment saw great growth. It jumped from $4.5 billion to $7.2 billion. That's an 8.1% annual growth rate. It's becoming a larger piece of the revenue pie. Finally, embedded. This is the future tech. Think automotive systems, industrial Internet of Things. This segment showed the fastest growth. Revenue went from $2.6 billion to $4.6 billion, a blistering 9.4% annual gain. So, the lesson here is clear. The old giant, compute and networking, is slowing, but the future is in storage and embedded chips. That's where the growth is hot. So, we have seen the full story. The chip company in Idaho, the one fighting giants like Samsung, and winning the race for AI memory. Now, the final question, the one that matters most. What is the potential? We look at the next 10 years. First, let's use a conservative benchmark. If you just bought the S&P 500 ETF, a safe play, your $1,000 would gain you $3,287 over 10 years, a good 3.3 times return. But we ran 3 strong projection models for Micron, our most conservative, based on projected EBITDA growth. It suggests your $1,000 would become over $19,000. That is a 19 times return. However, our most aggressive model, based on cash flow, forecasts something completely different. It projects your $1,000 investment could grow to an astonishing $14,330. That is a 14.3 times return of your money. A massive outlier. Combining all our projections, the average 10-year return sits at over 15.4 times. You could earn back over $15,412 by 2034. That is the power of the AI chip market. A tremendous but very risky upside. Is that risk worth the potential reward? That is up to you. So, we have reached the money part. This is the big one, the financial health of the company. Listen closely. We've gone through 3 main statements in the annual reports, namely the balance sheet, the income statement, and the cash flow statement. Each, we analyze multiple metrics to access if it is healthy. This will be discussed later. Right now, we will provide an overview. To get a top-line insight first, the balance sheet. Looking at the latest data, it is weak. 3 out of 6 metrics score good. That's an 50% good score. The company's foundation shows vulnerability. The income statement is a different story. Only 3 good scores out of 8, a 37.5% score. That is weak. Profitability needs work. And the cash flow statement, even weaker. Only a 25% good score. The recent cash generation looks strained. But let's pull back. We look at the big picture, the 5 key attributes of a rational investment: growth, debt, and value. Micron's recent revenue growth is bad. It's below our benchmark rate. Their EBITDA growth is also bad. Their ability to generate cash profit is lagging. And their free cash flow. It is currently highly negative. Bad score. However, there is good news. Their debt is manageable. The debt-to-EBITDA ratio scores good. They are not overly leveraged. And the final metric, the most important, is the stock a bargain? Our projection showed a potential of 32.3% CAGR. That is much higher than a market benchmark. The stock scores good on being well priced for that projected growth. So, the company is fundamentally solid. But the recent performance metrics, they are under heavy pressure. It's a turnaround story, massive potential upside, but serious short-term financial weaknesses. Now, let's deep dive into the specifics. Time for the financial deep dive. We start with the balance sheet. This tells us the company's stability. We use a simple benchmark. A good score is what we are hunting for. First metric, cash to debt. Does the company have enough cash to cover its debt? In 2024, the ratio was 1.08. That means $1.08 in cash for every $1 of debt. That score is good, they can cover it. The 10-year average is even better at 1.51. Strong foundation. Second, debt to equity. This shows how much they rely on debt versus self-financing. The rule is under 80% is great. Micron's latest figure, 31%. That's a good score. They fund themselves mostly with equity. Next up, preferred stock. This is a red flag. It means they need expensive, non-standard financing. Micron has 0. That is a good score. Fourth, retained earnings CAGR. Can they grow their savings even in a downturn? Micron's long-term rate is 25%. That is a strong, good score for growth stability. But here is a hiccup. Treasury stock. This shows cumulative share buybacks. Buybacks return value to shareholders. Micron's figure is 0. That is a bad score. They are not returning capital via buybacks. Next, we look at efficiency. Return on equity, or ROE. It measures profit generated from shareholder investment. We look for over 25%. Micron's latest is just 2%. That is technically a bad score by our high benchmark. However, the 10-year average is 11%. The last year was a cyclical low, making the score misleadingly bad. Finally, return on total assets, or ROTA. How well do they use all their physical assets? The goal is over 10%. Micron's latest is only 1%. Bad score. The 10-year average is 8%. Also technically bad. Overall, the balance sheet is stable. They manage their debt well. But efficiency zero and ROTA is lagging right now. That reflects the cyclical nature of the memory market. They are recovering from a major downturn. Time for the final financial check. This is the income statement analysis. We're looking at profitability and efficiency. First, gross profit to revenue. The rule is over 40%. This shows pricing power. Micron's latest figure, just 22%. The 10-year average is 33%. Both scores are bad. The memory cycle has crushed their margins. Next, SG&A2 gross profit. This checks if the product sells itself easily. The benchmark is less than 30%. Micron scores 20% in 2024. The 10-year average is only 11%. This is a very good score. They don't spend much to market or sell. Then the big one, R&D to gross profit, research and development spending. For a simple business, we want less than 30%. Micron spent 61% of its gross profit on R&D. That is definitely a bad score. But wait, they are a semiconductor company. They must spend big to stay ahead of rivals like Samsung. This high spend is necessary for long-term survival. Fourth, interest expense to operating income. Does debt payment eat up too much profit? The goal is under 15%. Micron's latest is 43%. Bad score. This means debt is costly when profits are low, but the 10-year average is only 8%. Good score. Debt is fine when the cycle is up. Next, income tax to pre-tax income. The credibility metric, we look for around 20%. Micron's latest is 37%. Bad score. The 10-year average is only 8%. Also bad, their tax structure is volatile, reflecting global operations. Sixth, net income to revenue, the profit margin. The ideal is over 20%. Micron's latest is just 3%. Bad score. The 10-year average is 17%. Still bad by this tough benchmark. Profitability is strained right now. Seventh, net income per share. Is the company consistently profitable? The latest figure is $0.7. Good score. The average is $3.4. Also good, they are still making money, despite the low margins. Finally, the debt-to-EBITDA ratio, the payback period. We want under 3 times earnings. Micron's latest is 1.46. The average is 0.89. Both are very good scores. The company can quickly pay off its debt. So, the income statement shows a company under stress. Low margins and high R&D spending are dragging the scores down. But the strong debt and sales efficiency show a resilient core. It's ready for the next cycle. This is the final segment of the financial analysis. We are looking at the cash flow statement. This is the real cash coming in and out. First metric, stock-based compensation to revenue. Are they excessively diluting shareholders by paying employees with stock? The benchmark is low. Micron's latest is just 3.32%. The average is only 1.74%. Both are good scores. Minimal shareholder dilution. Second, operating cash flow versus net income. The ideal is cash flow being higher than reported profit. It means the earnings are quality. Micron's latest ratio is 0.09. Bad score. The average is 0.41. Also bad, this suggests low-quality earnings during this phase. Third, FCF growth rate to net income growth rate. We check the growth ratios. The latest ratio is negative 0.9. That is a good score, as the cash outflow is not accelerating too fast. However, the longer-term ratio is 1.6. Bad score. High cash outflow is an issue. Fourth, capital expenditure to net income. How much are they spending to maintain or grow the business? The goal is under 25%. Micron's latest is 1,077%, and the average is 213%. Both are significantly bad scores. This shows massive capital spending. They are building new fabs, buying new equipment. It is necessary for the AI race, but it drains cash flow now. Finally, returns to FCF ratio. Are they spending too much on dividends and buybacks instead of on growth? The ratio should be less than 100% of free cash flow. Micron's latest is 671.9%, bad score. They are clearly spending far more on capital than they are generating in cash. However, the average ratio is 72.1%. Good score. So, the massive spending now is a temporary strategy. They are sacrificing short-term cash flow to chase the massive AI opportunity. It's a huge, high-stakes bet on the future. Let's quickly summarize the full financial picture. The balance sheet is okay, 50% good score, but both the income and cash flow statements are struggling. Profitability is low. Cash is being spent heavily. The company has a bad score for current revenue and cash growth. Why? They are making a massive bet. They are spending big to lead the AI memory market. But their debt to EBITDA is managed well. Good score. Now, the money shot. We look 10 years out. The standard market return is 3.3 times. Our average projection for Micron is a gain of 15.4% annually. The $10,000 investment could potentially become over $15,000. A 15 times return. It's a high-stakes, high-reward bet on the AI future.